Let's start off with that gross earnings number. As I mentioned, quarter on quarter, we saw a decline of 8% and gross earnings sitting at 41 billion Naira at this point in time. Tell us about the current business environment and the one that we saw taking hold of the business in the third quarter. It seems that many banks in Nigeria did experience some pressure, even though year on year it looks far better.
Yeah, indeed, Lenny. I think that the function of the market was that it was very long and very liquid, and therefore interest rates were particularly low, and that meant any banks with liquidity were significantly affected over the year, and the third quarter saw a continuation of that trend. For us, I mean, pleasingly, some of that was buffered by the fact that we managed to grow our loans and advances by a pleasing sort of over 30%, which certainly seems to be more than the market in general. So that did give us some cushion. But outside of the interest income as well is the fixed income activity, which certainly in Q2 for us was a feature of our results, which didn't repeat itself in the third quarter. But we do think that the fourth quarter maybe we see some of that activity returning. Outside of that, on the fee and commission income, for us, clearly we're not only just a lending bank, we're also a strong investment bank and advisory business, as well as a wealth business. And in the second quarter, we managed to close some very nice transactions which have a commensurate fee and commission income for us, which didn't necessarily repeat in the third quarter. But that's a little bit about the nature of the beast in that regard. So, having grown our net income, operating income at 8%, I think given the environment that we're all operating in is actually quite pleasing.
Well, let's just drill into some of the numbers even further. I mean, fair income down 16% quarter on quarter, and you're talking about some nice transactions that occurred in the second quarter that weren't repeated in the third quarter. This is why we're going to see a little bit of volatility going forward. What kind of sustainability do you foresee coming through with these big transactions that will help push your top line growth higher?
Good sustainability. Realistically, a lot of these transactions are long dated and they do take some time to get into the book. So for us, we're a little like a construction industry, and you want to see your pipeline and see what's coming through. And for us, it's looking particularly healthy right now. So given what's going on in the power sector and a lot of the power reform and the focus that is around infrastructure and the development thereof, we are pleased that the future does look good, and will continue should deliver some good fee income as well as interest income on the risk asset side.
Non-performing loans. Tell us about your recovery efforts in the third quarter, and when do you expect to see a substantial decline in non-performing loans?
I think we're making steady progress on the non-performing loans. We've said before that our book is somewhat skewed to a few largish NPLs in our CIB portfolio. But we are making decent progress in that. If we reflect back to December 2009, our NPL book has dropped 20%. So it's not just about a reducing ratio, given that our book has increased. We've also have seen some good recoveries and I guess workouts in terms of the NPLs. So we see that trend continuing. We're cautiously optimistic that we also continued improvement by the end of the year.
Cost to income ratio relatively high, sitting at around 70%. Tell us about your cost structures going forward, and where do you target that cost to income ratio number for the fourth quarter of 2010?
In the fourth quarter, we see it slightly below where it is today. We would hope that somewhere between the 67 and 70% level is probably achievable. Clearly, we are investing and we continue to invest. But as you will note, I think our OPEX line has only grown 15% for the year to date. And given that we've grown our branch network very aggressively, that's no small feat. So yeah, I mean, for us, it's both a revenue and a cost issue. But hopefully we can end up around the 67 to 70% level.
Of course, OPEX is down quarter on quarter. And you said that you have been expanding quite aggressively. Apparently 70 new branches opened in the last 10 months. We heard news from, of course, Standard Bank that it will scale down African expansion plans. Of course, it is about cost-cutting measures. How is this going to impact Stanbic IBTC?
Well, I mean, firstly, in terms of cost cutting, I think for Stanbic IBTC, it's less about cost cutting, it's more about cost containment. we've got a very clear vision about building scale in this market, and clearly we need to be responsible how we do that. But we don't see that our current plans will be massively affected by that. But certainly in terms of Standard Bank Group, Nigeria has always been seen as a very strategic market, and particularly in the sub-Saharan franchise, and that has not changed. Given the focus the group has currently got, it's largely around reviewing head office structures as much as it is about what's happening in countries. And I think there's very strong support for continued investment and for continued growth. But as a business, we would be we'd be naive not to worry about ensuring that our cost-to-income ratio stays in sync and that we get a return.
Well, Chris,
for the
I
investment
mentioned 70 branches opened in the last 10 months. So all these branches profitable at this point in time, or have they at least broken even?
No, you wouldn't expect them to be profitable in the context of pure break-evens. If you do your analysis, most branches you would expect to break even between 18 months and 3 years, depending on the size of that branch. Most of those 70 branches that we put in are smaller in terms of scale, in terms of number of people, and therefore do have a shorter break-even period. But if you take that they've only been in operation for an average of 3 to 6 months, certainly none of those would necessarily be profitable in terms of having returned your capital.
Of course,
and making
early days, Chris. Is Stanbic IBTC a preferred bidder for any of the rescued banks?
We're in the hat, as we've said before. I think if you look at the reasons that we would be looking for an acquisition, which is about building scale both at a network and potentially at a customer level, those principles stand firm. So, as we go forward, the process is still underway, and we wait to hear any results thereof. But certainly for us, we always have to think about that in relation to our organic plan, which is rolling along nicely. So for us,
are you in discussions at this point in time, Chris, with any of the rescue banks?
Yes, we are. We are, but as I say, we can't tell you where those got to.
Given the changes in the banking rules by the central bank, what license is Stanbic IBTC, considering that it has several subsidiaries which cannot be held directly by the bank unless it elects the holding company structure?
Yeah, given that we already operate a number of our subsidiaries, businesses which are the so-called non-bank activities, frankly, we're probably likely to end up with a holding company type structure. And the principle behind that would be to maintain the activities that we do currently in a slightly revised structure.
Chris, thank you so very much for those insights.